Hey folks, Steve Dale here. Today, our subject is going to be IRAs or qualified plans with special needs trusts, with a real focus on updates from the Secure Act 2, because that's what it says here on this paper. Okay, so that's what we're doing. For those of you that are new to us, we do these programs targeted to attorneys and fiduciaries here to work with attorneys and fiduciaries that work with the Golden State Pool Trust and really try to expand your body of knowledge when it comes to planning. As I like to say, simple and disability are two words that just don't go together. And Peter, is this going to be like a real simple concept today, or?
I think it's a little bit more difficult than that, Steve.
Yeah, so this is one of those things, but it's a real important subject as we get into this. But this is also available for other family members as well. Um, for those of you that are watching this, when you're doing planning for persons with disabilities, part of what we want to do is we want to be able to take those resources and be able to use them for the benefit of the person with the disability. And, part of that is getting a good tax result when we're talking about how we manage the trust. And the Secure Act here is certainly something where once you get through the basics of it, this is an area where you can bring a lot of value to the beneficiaries and the families. If and this is important, if we have a planner who understands how to set this up, and in some ways, more importantly, a fiduciary or a trustee who actually understands what's going on. So with that, part of this is we do want to get a good tax result. Interesting history on this. For years and years and years, planning has basically been the same. In fact, like a lot of things, there's a lot of planning that's been changing in the last few years, and it really does make it a challenge. So for years and years and years, we've been able to take funds and designate them to trusts. And especially since our focus is on trust for persons with disabilities, and do this thing called an accumulation trust. And the goal is, as Peter's going to go through, is to stretch out the payments here from these taxable funds. From usually it's a parent's retirement fund or that kind of thing that we're dealing with, and basically get a great tax result. When the Secure Act first came out, there was not an exception for special needs trusts here. And I was privileged, I guess we'll call it privileged, to be part of a group here, both through NALA and the Special Needs Alliance. And really, there should be a great shout out to the folks at the Special Needs Alliance. Believe me, they did a lot of focusing on the Secure Act. And we were able here pretty early on to get an exception in to keep the accumulation trust exception for persons with disabilities. And so once again, prior to the Secure Act, there were all sorts of different ways for folks to stretch out qualified plans for beneficiaries. But as we're going to see, those rules have changed dramatically. But in many ways, we're operating just the same, in some ways even better after Secure 2 for persons with disabilities. And more importantly, with this, also working with nonprofit organizations. Bottom line, as we go through all this is, and this may be one of those programs where you might want to follow it, watch it more than one time. I will tell you for myself, the first time I ever dealt with how do you do the stretch, what is the measuring person, and all of that stuff, I was so lost. And I had to go over it and over it and over it. One of our Pete's and my colleagues here, Brad Fergon, who is a master at this stuff and actually enjoys it here, he actually helped me really get my arms around it. And when you break it down to its smallest components, it's really not that that difficult. And once you get the hang of this, once again, I hope you're going to see the value you can bring for the benefit of a person with a disability and families. All that being said, let's get started here. And I'm just going to do some real quick introductions here. So Peter, if you can go to the next two slides. Oh, wait, this is important. Okay, so this program has been approved for 1.5 units of MCLE credit by the State Bar of California. Our provider is, once again, the nonprofit that is in charge of the Golden State Pool Trust, which is the North Bay Housing Coalition, which is provider number 14598. Each segment of this program has 3 codes that you're going to need to record to verify participation in the class. If you wish to receive MCLE credit, then you need to download the MCLE credit form here. And Amy, I might ask you to put the link in for the viewers here about where they would find that form. But you need to fill out the form and fill in the proper codes for each section. Now, if you don't have the form in front of you, just pull out a piece of paper and write down the codes here. So if you need the MCLE credit form, what we have here is to, you can email Amy at gspt.org, but you can also go to gspt.org and look for the tab for attorney resources, and you'll find the credit form there as well. Also, when this is all recorded and all this, the materials, there'll be a link for that. Next slide, we can pop through pretty quickly. I am going to be here to co-present with Peter, although once again, Peter's going to be doing most of this. Most of you know who I am, so let's get to the important person here, Peter Walt. Okay, now a couple of things about Peter. I mean, I would just tell you, one is full disclosure that TrueLink Financial is our investment manager. So those of they do all the investing for us. But also TrueLink has been a partner, not just for GSPT, but it's, it's amazing. Peter, how long has TrueLink been in business?
10-year anniversary this year.
It's hard to imagine a group that in a decade has made more changes to the positive here than TrueLink Financial. So TrueLink also has been really has been a partner, in many ways, both to the special needs and elder law attorney, but also has been a good partner with many different organizations. Pete itself, as it goes through here, has lots of experience prior to going to TrueLink. By the way, Peter is not an attorney here, which probably is why we're going to get a little bit more clarity from Peter than we might from somebody else here as we go through this. But, one of the things I really enjoy working with Peter is that he has a lot of practical experience when it comes to actual administration of the trust itself. So, once again, I know Pete and I do a lot of programs together. Part of this, Pete, really, part of what I appreciate is Pete takes it beyond the academic and takes it into the real world. And, and that's what I'm kind of hoping we get through after we go through all the obligatory going through the rules here. Hopefully we're going to have plenty of time to go through a lot of the practicality. Last thing before I turn it over to Peter is we are interested in questions. We are going to be monitoring questions. If you have questions, please put them in the Q&A. For the most part, we're probably going to try to take them towards the end here. And as I like to say, in a lot of cases, when you ask a question, odds are the answer will be in the next slide. So we'll see how this goes. Peter, can you take us through the wonderful world of the Secure Act and all of this other fun stuff?
Let's do it. Should be fun. So thanks, Steve. Great introduction. Appreciate it. And again, I'll just echo what Steve said. As you have questions, please put them in the Q&A. As you need help with the MCLE, Amy is absolutely fantastic and wonderful, and her email is on here. She has to put up with Steve all day long, so you know that she's extremely patient, and wonderful to work with. So
The
by
woman
all
is an
means.
angel. There we
That's
go.
right. That's right. So what are we going to be talking about today, and why? IRAs, individual. That's important to note. The very first word in IRAs is individual. Retirement accounts, 401ks, things of that nature. We're going to focus mostly on inherited IRAs today and how a family member with a child with a disability, as an example, can leave their IRA in a tax-advantaged way to that person with a disability. And as Steve said, make it last for as long as possible. Make it last for their lifetime, if possible, right? To fund the trust, make that special needs trust last as long as possible, but also to provide for the best quality of life for a person with a disability as we can by taking advantage of the IRS new rules around individual retirement accounts, IRAs, 401ks, things like that. So bunch of different types of IRAs. We're really going to focus on traditional IRAs. That's where the majority of the wealth and retirement vehicles in America is. So recall that as we're talking about IRAs, we're talking about most likely after the grantor, the owner of the original IRA has passed away, that 401k then is turned into what's called an inherited IRA. Okay. And that's really what we're going to be focusing on today. Generally, all income from a traditional IRA, whether it's done during the IRA's the original IRA holder's lifetime, any withdrawal from that, it's going to be taxed as regular income. Okay, so the federal government lets us put money away pre-tax, right, from our paychecks into 401ks, IRAs, what have you. But then when you withdraw that money, then it does become taxable income. There are some exceptions to this rule, as you can see here. But important to note that anything that we're talking about is going to be taxed as income to that recipient. Again, whether it's the original IRA holder, owner, it's sometimes called the IRA owner, or the ultimate inheritor, whether that be a special needs trust, a person with a disability, still taxed as income. And there is a distinction between how that income is taxed, whether it's in a trust or whether it's outright to the person with a disability, and how that can potentially negatively affect their public benefits. And we'll
So sometimes when you're kind of looking at mindsets for this kind of thing, something that's always helped me is everybody recognizes that the goddess of IRA planning is a woman named Natalie Choate. Even she recognizes that here. And, one of the concepts she has is that an IRA is kind of like the government putting a mortgage on your retirement plan. So part of what's going to happen is that you can put in your funds tax-free, or it's not tax-free, it's tax-deferred. So it can grow in a tax-deferred environment, but eventually the government wants to call the mortgage, right? Because why are they doing that? Well, because they've deferred the taxable income, but eventually the plan is that the income is going to come out and the government is going to collect their taxes here deferred. So it doesn't eliminate the taxes, it just defers them here. And part of what we're going to see as we go through this is how can we defer those taxes and then divert them to a person with a disability. And in some cases, I will tell you, I have emptied out multi-million-dollar qualified plans and not a dollar of tax was paid. So we're going to go through how could that happen?
Yeah. Okay, so as we're basically still just focusing just right now on traditional IRAs before they're inherited, generally, contributions are tax deductible, which is exactly what Steve just said, right? Pre-tax. The growth isn't taxed until withdrawal. And of note, generally, capital gains, appreciation on the investments within the IRA are generally never taxed, right? Only as they come out as income. So you don't really see a lot of capital gains situations within an IRA. You can see here some of the annual contribution limits. When we talk about, and this is level setting, okay, for everyone. So apologies if this is a little too basic. When we talk about a rollover IRA, that's an IRA that has been rolled over generally from a 401k to an IRA. And this can happen during the account owner's lifetime, right? They switch jobs. You can keep the 401k at your old job, or you can have it managed somewhere else. You can manage it yourself by rolling it over to an IRA. So from a qualified plan, a 401k to an IRA. As you're contemplating this, right? So even as you're a fiduciary and you're like, okay, well, this original IRA account holder has passed away. They've opened an inherited IRA at whatever, insert XYZ custodian here. Now I want to move it to my investment manager, and they're asking me, okay, well, do you want to do any withholding? And they're going to ask that. What you generally want to do is what's called a custodian to custodian transfer, or a direct rollover, or even if you're talking to the plan provider itself saying, hey, this IRA is payable now to the special needs trust. They're going to ask you, okay, what kind of withdrawal are we doing? Because they could just issue a check out directly to the trust. Don't do that. That is a taxable event that then you have 60 days to establish a new IRA upon issuance of the check. And you just don't really want to start that clock ticking, because then all of a sudden, everything in the IRA has become taxable as income to the trust. And we'll talk a little bit about what that means. So as you're dealing with these, they're called contra firms, or the firms that are transferring the assets to you as fiduciary to manage for the special needs trust, let's say, for the beneficiary, you're going to need to ask for a custodian to custodian transfer or a direct rollover. And then they're going to ask you, okay, do you want to do with any withholding? Well, why would I want to do with any withholding, Pete? There's no tax due on any of this stuff if it's a direct rollover. And that's the exact right question you should be asking. There is no tax due. Okay. And a lot of times, though, they're going to, say, hey, do you want to hold 15, 25% federal tax? And there's no tax due. Here's the other and so you don't need to do it. But here's the other reason not to do it. If you withhold, let's say you have $100,000 in what's going to be an inherited IRA, and you're like, I just want to be safe. I don't trust that Mr. Wall or Mr. Dale or what they're saying, and I want to withhold 25%. Well, guess what? You have to fund that IRA with $100,000, even though you've withheld 25,000. Withholding means that you've sent it to the IRS, and you have to fund that at the time the account is established, or you haven't done a full rollover. So now you have to come up with an additional $25,000 from somewhere, and you're not going to get that $25,000 back from the IRS until the trust tax return is filed, generally in April of the following year. And so how are you going to do that? So again, be really careful as you're looking at doing, withholding between different custodians and investment managers. Okay, as we look at, and as you're as a fiduciary, so again, level setting, building some ground framework here. When you're looking at an inherited IRA, a lot of times these will be called, if you're looking at a statement, right, you're taking over a successor trustee. You look at what the heck is a beneficiary IRA? Or why does this particular account, title say Pete Wall IRA for the benefit of, my daughter Mackenzie Wall, trustee, blah, blah, blah. Et cetera, et cetera. That's generally a good sign that this is an inherited IRA. And so you just need to do a little bit more due diligence and dig a little deeper, which we'll go into when you're talking about required minimum distributions from the IRA to the trust. Okay, now all of that ground and level setting, have happened. Let's talk about the Secure Act. So the Secure Act came about at the end of 2019, quite frankly, to the surprise of a lot of planners, right, Steve?
Well, it surprised a lot of us, and part of this was that they were looking for revenue, right?
Well, sure. We'll kind of go through that here, and I kind of get tired every year of hearing about, the uncertainty of Social Security payments guaranteed into the future, but it's a real thing. It's a real thing. So a lot of this is the government stepping up and encouraging people to, save more for retirement in the event that Social Security won't be as robust in coming years. And you kind of see that with defaults of pension plans and things like that, and really starting to try to make the consumer plan for their own retirement and things like that. So as Steve said, Secure Act kind of comes out of nowhere, and it stands for the Setting Every Community Up for Retirement Enhancement. And like every bill that goes through Congress, and I'm not pointing fingers, it's a lot. There's a lot of things to think through on this. There were mistakes made, there were omissions, and there were, things that just needed to be cleaned up. And so that was followed at the end of 2022 by the Secure Act 2.0, by the Rise and Shine Act, the Retirement Improved, blah, 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 and the Earn Act. So what did we learn from all this? Apparently, Congress really likes acronyms. That's what I took from it. And having, these really long bills. But what happened is the IRS eliminated the stretch for many beneficiaries. And so what used to happen is when somebody inherited an IRA, for example, if I were to have inherited my father's IRA before the passage of the Secure Act, I could then delay taking out those funds, which is again taxed as income over my lifetime. Okay. Now that stretch, and that's really tax advantageous when you think about it, because the funds are allowed to stay in the IRA to grow tax deferred and only taken out when I need them. Okay. Now, when the Secure Act is passed, the stretch is eliminated for most beneficiaries. A lot of beneficiaries must now withdraw all IRA funds within 10 years of the IRA owner's death. There are exceptions, and that's why we're talking about them, one of them being people with disabilities. And you can see here now, required minimum distributions are just like what they sound. They're the minimum amount that you're required to take out as an IRA owner, whether that's inherited or you're the actual IRA owner. And that begins, you can see here, that sort of stretches out and goes farther out here in 2024, extends again in 2023, and things like that. Now, the Secure Act had 90 new provisions in it. Now, don't worry, you don't have to read them all. We did it for you. Here are some of the interesting ones, right? We have this catch up in contributions increase. So again, here's the government just encouraging the US population to save more and more for retirement. Interesting on the Q-tip, not the qualified terminal interest property trust, but the qualified tuition program, or the college 529 plan, can now be rolled over into a Roth IRA if it's not used. But note how small the exclusions are on that. There is supposed to be a 401k database being set up. I've seen nothing on that yet. I could be wrong, but think of it like your state's escheatment office, where it's like, hey, you've got money that was never cashed and the state's holding it, or checks, that the state is holding. And this will be really, really helpful for personal representatives, executors of the estate, to go in and say, hey, where's all this stuff? And, et cetera, et cetera. Of note, especially for the fiduciaries on the call, there is this missed RMD penalty reduction. So it used to be, so imagine that you take over, somebody has passed away, you're the executor, you're funding the estate, you forget to do the RMD, or you take over in November, you don't have your hands around the account until January and no RMD was taken. Well, there could be a 50% penalty on that. Now that's down to 25%. And only 10% if it's rectified by the second year following the date that it was due. Okay, this is a big change and really, really helpful for fiduciaries. There's also an exception process. I think it's called a Form 5329, that as the trustee or the fiduciary who's missed this, you can say, hey, I'm not trying to cheat you guys being the IRS, out of tax money. Rather, we just missed it because the person died in November, or things like that. And I've been very successful in filing those forms in the past, and the IRS is generally very sympathetic to those particular situations. Steve, you want to?
And then we come to our first code. So for those of you that are taking this for credit, our first code is 1112. That's 1112. And keep in mind, as the slide says, that if you don't have the MCLE form, you can go to gspt.org/attorney resources and download it. Anyway, moving ahead, Pete.
Moving ahead. Okay, so now this is the most important part of the Secure Act, is how do we name the beneficiaries on our IRAs, on our plans, so that we can get that stretch. Obviously, that, and to sort of go backwards just a little bit, when Steve said, hey, IRS is looking for more tax money, obviously that's part of this, right? The elimination of the stretch for children, for example, of a decedent now only being able to stretch it over 10 years, obviously gets the IRS their money in a much more efficient and quick manner. But we need to be very careful, not only as planners, but as parents of children with disabilities, and as attorneys and things like that, to make sure that we are doing everything that the Secure Act tells us we have to do so that we can garner or gain that stretch for the required minimum distributions for our beneficiaries. So there are 3 different types of beneficiary types that you need to know about. We want to generally, if we're just talking about planning for a child with a disability who will have a special needs trust, or even without, we generally only focus on one. And that's on the next slide. But first and foremost, let's talk about non-designated beneficiaries. This is basically worst case scenario. Okay, someone hasn't done the proper planning, things like that. And that's if you name an estate, if you name your estate, a charity or a non-qualified trust. Non-qualified trust meaning it's not irrevocable. They can't find the beneficiaries, right? So Steve and I were having a hypothetical conversation about powers of appointment within a trust document, and would that kick you into NDB or non-designated beneficiary land? The answer is maybe. But if the client has named their estate, and that's a drop-down box, right? On a lot of these plan providers forms, it's a drop-down box. Then all of a sudden, we're in 5-year land. So we have to withdraw the funds from the IRA in 5 years, or, and this is my favorite IRS term in the world, if the account owner was over 72 and a half, then you continue to take the required minimum distributions over what the projected lifetime of that beneficiary would have been. And that's called the ghost expectancy rule, or the at least as rapidly rule. It just conjures up images of Scooby-Doo and the gang there for me with the ghost expectancy rule. But that's what we're trying to avoid, right? We're trying to avoid getting into that 5-year land. Now, your next type of IRA beneficiary is called a designated beneficiary. That would be any individual or see-through trust. And hold your questions. We'll get to the difference between a see-through and accumulation trust. But of note, it's a non-spouse. So spouse still qualifies for the stretch. We'll get into that in a second. And these withdrawal rules are within the next 10 years, plain and simple. Okay. And that's going to be the majority of what the Secure Act was attempting to address. And then, as Steve said, through great advocacy work, both on NALA and the Special Needs Alliance, or SNA, we have this class. This is what we're going to focus on today, which is called eligible designated beneficiaries, or EDBs. And these are the folks that can stretch the required minimum distributions over their lifetime, which is what we're shooting for, right? This is going to be a spouse, a beneficiary with a disability, and you can see here that the IRC, Internal Revenue Code, qualifies a beneficiary with a disability very similarly to how Social Security does.
It's really close to Social Security.
Right.
Yeah.
Tying it back to substantial gainful activity. A beneficiary who is chronically ill, and you can see the definition there. Individuals not more than 10 years younger than the decedent, which they were basically saying, well, this is going to be basically a wash anyway, so let's just do it. And then minor children of the decedent. Okay. But it's important to note that it's during minority only. Okay. So the beneficiary, if it's a minor child, let's say the beneficiary, the IRS went ahead and defined the age of majority for us. So you don't have to go state to state for this, because it is different as 18 years old. So let's say the minor child inherits when they are 12. They have 6 years of using the stretch tables, and then they have 10 years after they become of majority to withdraw the rest of the funds.
So you can tack them together.
You can.
In that instant.
Yep. Steve, did you want to touch a little bit about the difference or what a see-through trust is?
So part of this with a see-through trust here is in order to qualify, because you notice that one of the things to be a qualified beneficiary designation with a trust, it had to be a valid trust. So here are the rules, and it's actually pretty straightforward. First off, the trust has to be valid under state law. I mean, that's really not a high threshold. I tell my clients, hey, you paid good money for this, so it is valid under California law. But this is really key. It needs to be irrevocable or irrevocable at the time of receiving distributions. I believe that Brad and I were the first to incorporate this in the Wealth Council Trust here. So you'll notice in a lot of trusts, it'll have a trigger in the special needs trust that'll basically say that upon receipt of any qualified plan here at that point, the trust will become irrevocable. And so that's a very common way now. I see that in a lot of different trusts out there, but that's something that's important. A copy of the plan has to be provided to the plan provider by October 31st of the following year, following the account holder's death, right? And
yeah, and there's just as a side note, there's not a real good policy for this yet. At least I haven't found one in between, different custodians and Schwab, Wells Fargo, insert whatever financial institution, TD Ameritrade, whatever the case may be here. There's not really there hasn't been anything really established that I've seen, at least, where it's like, hey, upload your document here, but just know that that is a requirement under the IRC.
And Pete and I have worked on a couple of cases together, and a lot of the plan providers and all of that, they're adjusting to all of this, especially when they're dealing with a person with a disability. So there we go. All countable beneficiaries must be identifiable, and that's something we're going to spend a modest amount of time on. And they have to be individuals. And here's one of the big things that happened, and this was a big push when we were working on once again trying to get clarity out of the IRS with both the Special Needs Alliance and NALA. Was we made a big push about charities. And one of the really cool things that has come out of this is that in the past, you wouldn't be able to designate it to a nonprofit, a charity in the end, because the point of the thing in the old accumulation planning is that a nonprofit has a heart, but it doesn't have a heartbeat. Well, guess what? The IRS gave him a heartbeat too. I guess it's like the Wizard of Oz here, huh? Here as far as that. So charities are individuals now. How's that?
Yeah, and we'll really show you how that makes so much of a difference here when you're because we're still not done. So you can see all of the different ways, and the charity being being an individual now helps, but there are still further things. There's more hoops we got to jump through, guys, to make sure that we can do these required minimum distributions over the lifetime of the beneficiary. So here, Steve did this, was kind enough to do this about how the Special Needs Trust Improvement Act changed part of the Secure Act 2.0, no individual meaning no beneficiary now. So again, why are we talking about all this? The advantages of being an EDB, or an eligible designated beneficiary, means continued qualification for means tested public benefits. In other words, if the beneficiary with a disability was named outright in the IRA beneficiary designation, guess what? All of a sudden they have a resource now, which could negatively impact their qualification for means tested public benefits. By leaving as much of the funds in the IRA as possible, inherited or otherwise, it means that the assets continue to grow tax deferred, and it's less likely to push beneficiaries into a higher income tax bracket over the next 5 or 10 years. Michelle asks, plan provider must receive a copy of the trust. What is the plan provider? So that would be the custodian, the Fidelity, whoever is managing either the 401k or the IRA, wherever those assets are held.
Great. By the way, kind of a planning observation for many of us for years and years, and this is something else that once again Brad and I worked on here when we were working on the Wealth Council Trust, is what we called the qualified plan savings clause, which was basically a clause that we put in the trust that says for any for any qualified plan that it shall not include a charity, because back then that would have put us into a 5-year rule plan, which is what we're trying to avoid. For those of you that have that clause, and if you're looking at leaving something to a nonprofit, and let's face it, there's a lot of disability organizations out there that really improve the quality of life for persons with disabilities. You might want to take a look at that clause here and talk to your planner and see about changing it. So now nonprofits are individuals.
Yeah. I think it's a super important part here to take a step back. Now that we know, hey, who should we be naming if we want the EDB stretch? Beneficiary designations are extremely important. Okay. It's one thing to have the best plan in the world, but if it's not executed upon before the grantor or settlor of the trust has passed away, then it's all for naught. And what do I mean by that? I mean that if you name your child just simply by oversight, your child with a disability, as the beneficiary of your IRA or 401k, as opposed to the special needs trust, guess what? But your trust says the special needs trust should be the beneficiary. Guess what? The beneficiary designation on a checking account, on an IRA, on an investment account, those beneficiary designations supersede your will and your trust. So you need to be very, very careful about going back. It's always an ounce of prevention is worth a pound of cure. In this case, sometimes there's not a cure. And checking those beneficiary designations so that you're making sure that the plan that you've put together is actually the plan that is executed. Is that fair, Steve?
It works for me, man.
Yeah.
And we have a question that we'll get to a little later here. So, Kenneth, we're not ignoring you, at least for now.
Oh, yeah. Yep. We'll get to that 100%.
Yeah.
Okay. So also included in the EDB or eligible designated beneficiary categories, or again, that class of beneficiaries that can utilize the stretch are see-through trusts or qualified trusts for a person with a disability. Now, what do these things mean? A see-through trust or a qualified trust basically mean the same thing. And then there's two different types. Okay. Steve went through the requirements of the see-through trust, which aren't very high bars to hurdle, right? But then we need to understand, okay, what's the difference? What kind of trust do I have? A conduit trust basically means it's just like it sounds like, guys. It means we're going to receive money from the IRA, whether that's required minimum distributions or otherwise, and immediately kick it out to that beneficiary. This is great because then what it does is it doesn't subject that income. Okay, because remember, any withdrawal from an IRA is taxable as income. It doesn't subject it to the federal trust income tax rates, which look how high these suckers are, right? You can see here, if you receive over $15,000 in income, and this is net income, we're not going to talk about distributable net income and things like that, or actually maybe we are, maybe these are in the slides later, but net income trapped within the trust is taxed at 37%, whereas a lot of our beneficiaries with special needs, with disabilities, they don't pay taxes at all. So this is a great option, right? If we just want to kick all the income out of the IRA directly to the beneficiary. Sure, it's a great option for tax planning, which is generally why it's done, but it's a horrible option for special needs trust. Absolutely defeats the purpose, because what does that do? If you have to turn around and kick that income out directly to the beneficiary, all of a sudden they have a resource problem. They have an income problem. They're going to be kicked off public benefits. And so we don't want that. So I've actually never seen a special needs trust, thank God, that is a conduit trust. Most of them are accumulation trusts. And what that means is when the distribution is kicked out of the IRA to the special needs trust, it accumulates there. And then it's at the trustee's sole discretion whether to use that money to or for the benefit of that beneficiary. So they keep their means-tested public benefits. The IRA, the trust is no longer a resource. They don't have an income problem anymore. And then the trustee decides, okay, I'm going to pay for this car, whatever the trustee out of a special needs trust decides to pay for that beneficiary. Then what happens with that income? So I guess we are going to talk about distributable net income. What happens to that income then from the IRA proceeds is that it does get passed out to the beneficiary through those distributions. It's carried through to that, but it has to make that stop first. It has to make the stop in the trust first and then be distributed out by the trustee. And then it's taxed at the beneficiary's tax level. So I know that's a little bit
Kind of
confusing.
an
Go ahead.
observation, because we were talking about this prior to the webinar. Many of us are adjusting to the change in our Medi-Cal rules in California, where we've eliminated the resource rules, but we have not eliminated the income rules. So here's another reason why you wouldn't want to do the conduit trust, because with the conduit trust, it not only has to shoot right through the trust, but it has to be distributed in cash. And that is one of those situations that a distribution in cash is going to be income for Medi-Cal purposes, and almost assuredly will kick the person into a share of costs. So as we kind of get through scenarios and things like that, we have new things to look out for and that kind of thing that maybe we didn't do before. And Pete, I've never seen a conduit special needs trust or something. I probably will someday, but it would be a very special situation where you'd want to do that.
It'd most likely be a mistake, one would imagine,
Yeah.
right? And so any income, I will touch on this, and thank you for that, Steve, because Medi-Cal has gotten, a little bit more difficult in all the right ways, right? In all the right ways, it's gotten just a little bit more tricky to plan with. I will say that let's imagine that you take, let me make the math easy on myself. $15,000 out of an IRA, it comes to a trust, but you only spend $10,000 on the beneficiary. Well, all of a sudden you have that $5,000. It's called trapped income, and that remains trapped within the trust. And then that would be subject to these higher trust income tax rates. But all of a sudden, now we're talking about $5,000, right, at 25%. Okay, that does, I'm rounding up, excuse me, from this 24%. Okay, is it worth, that X amount of dollars to pay in taxes to keep that beneficiary, a couple $1,000 to keep that beneficiary on public benefits? You're gosh darn right it is, because those public benefits are covering a heck of a lot more than what would remain trapped in the trust. So generally, really, really favorable tax treatment here for people with disabilities, which the IRS has always been known for. Okay, but remember, like I said, we're not done yet. So we have to look at everything before we can determine what are the RMDs, what tax table do we use to make sure, or excuse me, to distribute these funds out of this inherited IRA. So there's 3 tiers, really. First tier being any beneficiary who could receive amounts in the trust. Okay, let's count that as our first tier beneficiary. Okay, so that's great. So that says, in the trust or in the IRA, inherited IRA beneficiary designation form, this is our person with a disability. Okay, great. So as long as they're an EDB, we're ready to go. Second tier, any beneficiary that could receive amounts in the trust representing the employee's interest. Okay, now we're talking about our remainder persons, right? We're talking about secondary beneficiaries. So to Candace's point, if we name in our IRA, I want everything to go to my child's special needs trust, but should they, God forbid, outlive, or excuse me, not survive the IRA funds, in other words, there's funds left over after they've passed away, then I want it to go to my daughter. Okay, that's your second tier beneficiary. All right, and that would be a designated beneficiary in Candace's example here in the Q&A, because that daughter does not have a disability. Okay. And then third tier is any beneficiary who could receive amounts from the trust that represent an employee's interest because of the death of another beneficiary. Okay, here's the takeaway from that. And you'll notice I skipped over that. I skipped over that for a reason. First tier beneficiaries always count when we're determining, hey, what's the RMD schedule to use here? Is it 10-year or is it 5-year? Let's hope not, right? Or is it EDB, which is lifetime? Third tier beneficiaries never count because, quite frankly, almost always beneficiaries who predecease the account owner or the first tier beneficiaries don't count anyway. So we're really looking at first and second tier. So in this particular case, we have an EDB and a DB. Awesome. That means for the EDB, we're able to take required minimum distributions over their lifetime. And then then it becomes inherited by, the remainder person, then all of a sudden we get the 10-year kicked in. I don't think that's necessarily, Candace, all of your question. And so I think your question may be a lot more easy than that. I think we may have complicated it. That's what we tend to do. But what I think your question is really, on my IRA beneficiary designation for the one child with a disability. Most likely, you're going to name the EDB special needs trust, or the special needs trust for the benefit of my daughter with a disability. And then on the other 50%, and you can do that, right? You can do 50%, you can do percentages, and we're going to walk through a real life example of this at the end. For the other one, then you would say, hey, for the other 50%, this goes to my daughter without a disability. And then when she receives that, then she gets it over the 10-year. Okay. It's probably a lot easier than we made it.
I think when we go through the examples, it's going to be a lot easier. So
yeah. Here's a real handy distribution requirement table that we put together for you as you're dealing with these particular questions.
So ready for our second code. So for those of you that are taking this for credit, code number 2 is 3325. That's 3325.
Great.
Plowing ahead, Pete.
Okay. So we keep talking about this darn thing called a required minimum distribution. Well, Pete, how do I figure this out once I've got everything established? Well, pretty darn easy, to be honest with you. You just take these tables that are down here. Most of them are going to be the single life expectancy table, which you see down here at the bottom, and they're in the IRS publication 590B. Here's the problem. You're not going to have a lot of the financial institutions, custodians, financial advisors, et cetera, haven't caught up with this stuff yet. So, and they will, like, no doubt. It's not going to be a big deal soon. But a lot of times what I encourage is, hey, make sure, because they're going to come back and tell you, well, it's a 10-year rule, or it's a 5-year rule because you named a trust, or blah, blah, blah. It's probably not. Okay. So go back. You've learned a lot today. Go back to your attorney, your planner, whatever, and say, hey, I really do think I have an EDB case here. Once you have that confirmed, it's so simple to calculate this stuff. It is ridiculously easy to calculate it. And a lot of times, even some of the bigger, wirehouses won't even calculate them for you anymore. If there's a trust involved, they're like, we don't want the liability. We don't understand this stuff yet. And it'll get there. It's not a problem, but just know that right now, while things have just changed, that it's a little bit wonky.
Well, Pete and I have worked on a couple of cases with this, and just to put it into context, prior to Secure, if you were trying to do tax-wise planning, the trust was the general rule, right? Now, we are the exception to the rule, because for a lot of folks, there's often other times for non-disabled folks to use a trust, but for the most part, since the majority of folks are going to be under the 10-year rule, we're going to see, a lot of times it's just easier just to send it directly to them. So we have been, instead of part of the general rule, we are now part of the exception to the rule. And Pete and I have had experience with a couple of plan providers where they're adjusting.
Right. And it's difficult to sort of navigate some of those things, but the cases in particular that Steve are mentioning there are creative solutions to basically try to achieve the original intent of the plan, but it's never as perfect as just going back, and I'm going to say this probably a couple more times, go back and check those beneficiary designations. Doesn't hurt anything, doesn't take that long. So when you go back and you check those things, and just make sure that it's done right the first time, it really saves a lot of headache and a lot of potential taxes at the end of the day when you've passed away as the account owner, or your client has passed away. And then again, just to summarize, then all you do is you find this table. It goes age, right, in one column, age of the beneficiary, right? If we're dealing with the EDB, so let's say they're 24 years old, you go to 24, and then the next column over is the factor. And you just divide the prior year's 1231 value. So you just need the statement for 1231 by the IRS life expectancy factor, take that as required minimum distribution, and you're done. It's literally that simple. once you've worked through all the other stuff that we talked about.
Kind of a little conceptual tool that's worked for me for many years. Once again, maybe we should have had Brad on since I just keep referring to him here. But this is something Brad taught me. The tables are based on the assumption that we all live to be 86 or 87 years old, right? So if you want to kind of work this out in your head, and it's not going to be accurate to the penny, but it'll be generally that. If you have somebody who is 57 years old, and once again, you're calculating, the table is going to assume that they're going, if they're 57, that they're going to live for 30 years. So the first year distribution would be 1/30th, followed by 1/29th, followed by 1/28th, 1/27th, and so forth. Not accurate here, but it gives you a general idea of what you're dealing with versus if we're stuck with the 10-year rule, our math is a little different. So anyway.
It is. All right, so let's put some of this hypothetical knowledge into practice here. Okay, let's just start with the basics. So you can see here in bold where I've highlighted where the beneficiary's ages change. These are the only changes to the fact pattern. But let's imagine we're the fiduciary, the family member trustee, whatever the case may be, and we're trying to figure out what the heck, who's measuring life? What do I use 10-year? Do I use blah, blah, blah? Let's figure this out. Okay, so we have a third party special needs trust, right? Established by someone other than the beneficiary with a disability. Beneficiary is 50 years old in this particular case, and in all fact patterns. The third party special needs trust was appropriately designated as the IRA beneficiary. However, we enter those tiers and we say, okay, beneficiary's sister is the third party special needs trust remainder person, and she's 40. Okay. Fact pattern 2, sister is now 60. Okay. Fact pattern number 3, a pooled special needs trust, as you know, as the man behind the curtain there, the Wizard of Oz giving a charity a heartbeat now said, is now the third party special needs trust remainder person. So Steve, how do we figure out who's measuring life to use?
Well, we look at this handy dandy. Here's kind of the good news. It used to be that we would go through all sorts of different hoops and that kind of thing, but this happens on occasion. Things actually got simpler. I mean, basically, we're looking at the first tier beneficiary.
Yeah, pretty neat, right? I mean, we did used to have to go through and be like, crud. Okay, now we have to combine the beneficiary's age with the remainder person's age and figure all this out. Now we don't have to. All right, we just use the EDB, or eligible designated beneficiaries, measuring life expectancy, and we're done. Pretty neat. Okay, now this is the one that maybe for Candace is a little bit more applicable. So, and I think this is probably a scenario that Steve came up with that I think a lot of planners are dealing with. So I'll go ahead and turn it over to you, Steve, to do
Well,
this.
I think it kind of comes up with the concept that not only are not all children equal. I mean, we get this all the time as planners. I want to be equal to my children and I want to be fair. Now, once again, in families, I don't know about your family, fair and equal are just not things we deal with, but let's say that's what you're shooting for. Well, even if you're trying to be equal, you don't need to be equal with the actual assets that you're dealing with. And part of this here is meant to illustrate it. So let's say we have a situation, and to make it easy, and by the way, we get these where we have twin daughters born at the same time. Here, one has a significant disability and expected to have a lot of medical expenses and that kind of thing. Here, and one that does not, right? And the typical provision that you see, I call it, is that since we want to be equal, we're going to take every single asset and divide that in half, right? Which I'm going to suggest to you is a big mistake, because these sisters are not equal, right? So we have half of it going into the third party trust with the sister as the remainder person, the other one going to the daughter without the disability, going into her outright, right? So let's presume that what we're dealing with is, to make the math easy for us, $500,000 in IRAs, $500,000 in life insurance, and $500,000 in qualified investments. Okay. So, and one of the things to keep in mind is in the qualified investments, we get a step up in basis upon death. So we have IRAs that are just chock full of ordinary income, life insurance that has no income, and investments, which, depending on how the trust is set up, may have a step up in basis. And so, for instance, if it's sold, it won't have any capital gains. So, also the thing is, it says here, the tax, and this is very common, the tax brackets are going to be very different between the two sisters here. In fact, it's not unusual that the sister with the disability is not in the tax bracket at all here. And then once again, we want to assume that the third party trust is going to pass out all the income to the daughter, not retain it and subject it to that compressed tax rate. Okay, so moving ahead. So just looking at this, if you look at the daughter with the disability, and you can kind of see what I'm telling you about the 86 or 87 rule. You can see the life expectancy goes down each year by about a year, right? Her RMDs are about 13,000 and change here, and her taxes due here, and this is without any tax deductions at the beneficiary level, are going to be about $1,657 a year. For the daughter without the disability, it's going to be subject to the 10-year rule. Now, Pete, as I understand it, we don't have to take it out over we don't have to make it $50,000 a year. It just has to be over 10 years. But if we took it out at $50,000 a year, that is $50,000 of taxable income, which equals $16,000 a year.
Yeah.
And it may be in the next slide, but there's a real good chance that the daughter with the disability is going to have all sorts of medical deductions at the beneficiary's rate. So my experience has been in those situations, she probably won't pay any taxes at all.
Yeah, I think that's right, Steve. The taxes due is based on her 12%, which is just trust income, because recall, and this is more for the audience than for you, Steve, but SSI is generally not taxable. SSDI is generally half taxable. So you're absolutely right, with the caveat being, even with the standard deduction, right, for the beneficiary or for the daughter with a disability, she probably wouldn't pay taxes anyway, let alone itemized deductions to include the medical expenses.
So I think another way to look at this is with the third party trust, you could take it over the beneficiary's lifetime. The daughter without the disability, it's 10 years, right? Here, as we illustrated, the income passes out of the trust. Here, if you have distributions here, here, and it's going to be taxed at a lower tax level, oftentimes offset by medical deductions. For the daughter without the disability, you're going to pay the higher rate, and you're going to be stuck with the standard itemized deductions and that kind of thing. Remember, part of this isn't just the income; it's having the investments grow in a tax deferred environment. For the daughter with the disability, it's going to continue to be able to grow in that tax deferred environment. For the daughter without, not so much. Now, when we're looking at cherry picking what goes where, we got all this wonderful life insurance. And the life insurance industry just loves the special needs planner, because oftentimes, legitimately, people will buy insurance, and they'll buy it oftentimes for the special needs trust. I'm kind of suggesting in some sense, like in this situation, you need to think of it more as a pot, because that nice tax-free life insurance is actually more valuable to the non-disabled daughter than it is the disabled daughter. Or the other part is with the investments. Once again, normally here with the investments, once again, they're going to get a step up in basis if it's after the parent's death, depending on how it's set up here. And once again, as you're kind of looking at your planning scenarios, as a planner or as a fiduciary, you might want to look and cherry pick what assets are better off in the hands of the special needs trust and what is better off with the other folks. Once again, I would suggest to you here in this situation that I would suggest designating the entire qualified plan to the special needs trust and then divvy up the other stuff. Now, what is this QDT exemption other than a box up in the upper left-hand corner that the CPA probably has never checked, right? It has always asked, what the heck is this thing? Well, if you have a trust, and there are some rules in this, and then is this covered in the next slide? Because that's real common.
No, it's not.
Okay, so in the
I'm
QDT
super
exemption,
glad you brought it up.
There's a couple of real easy rules, right? First off, the beneficiary, when the trust has to be effective before the beneficiary is 65. So you may have situations here where and you might want to put a tickler that if this is a big part of your planning here to get this QDT exception, which is basically it's a $5,000 tax exemption.
Correct.
Right. It's kind of a freebie here that you'd want to make sure the trust is actually up and running before 65. You could put a nominal amount in it. It doesn't say you have to have qualified plans in it. And the other part of it, it has to be irrevocable and it has to be for a person with a disability. I mean, the rules are pretty straightforward.
It is. It gets a little difficult if you have, especially when you're trying to you have to meet the Social Security definition of disability. So if you have deeming problems potentially and blah, 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 which we're not going to get into. But it's an above the line deduction, basically an exemption that would reduce that taxable income by, I think it's $5,050 in 2024.
And the cool thing is you get to check the box up in the upper left-hand corner. So
right. It has to be for the sole benefit of that beneficiary. Exactly. Here's actually where I see it actually used incorrectly a lot, Steve, is on trust for multiple parties. And you have a lot of tax preparers, and this is a very specialized niche, right? So make sure your CPA is very astute and very good at this, where they'll just say, well, this person has a disability, and maybe it's a marital trust or a family trust, and they'll just check that anyway. And they don't qualify for that exemption. So just be careful with that. Okay, so let's talk about accelerated distributions from the IRA. So in this particular fact pattern, we've got a minor beneficiary. I'm sorry, earlier I said that the Internal Revenue Code says that people people are of minority until age 18. I was wrong. It's 21. I apologize for saying that. It's age 21, not 18. So throw away what I said earlier. Apologies. So you have a minor beneficiary here who has a conservatorship. 17, inherits, unfortunately, his parents pass away, right? Here's his current tax bracket. Age of majority is 21. He's eventually going to start working, right? Or at least that's the plan, at age 21 at the 22% tax bracket. So what happens if we just take what we're allowed to take? So we just say, okay, I'm the trustee. I don't want to get in any trouble. I don't want to think this through. I don't want to do my due diligence. I'm just going to take the required minimum distribution for the years up until I can, and then hit the 10-year rule for when I can. And recall that all of this is taxable when it comes out of the IRA. I know I've said that 8 million times, but it is taxable. So if we just we don't factor in investment growth, which typically doesn't matter in these particular Monte Carlo simulations. If we just pay, you see here, if we just do the RMD, required minimum distribution, over the minor's lifetime, the lifetime over the age of their minority, and then 10 years thereafter, we've paid 86 grand in taxes, or 21% of the original corpus. All right, I guess we're stuck, right? Well, not if you really think it through. What if you don't have to take just the required minimum. That's just it. It's just the required minimum. You can take it all out in the first year if you need to, for the beneficiary's need. But let's just say we do a little bit more tax planning here. We take more out when the beneficiary's at a lower tax rate, and look at the savings that we've generated just by doing that for this minor beneficiary. and things like that. So really, really helpful to really dig in, get specialized advice, from your planners, from your attorneys, and take a look at this thing. And I think a lot of trustees, fiduciaries in general, are reticent, quite frankly, to take more than the required minimum distribution. But there certainly are scenarios wherein it's prudent, where in fact it should be encouraged. Obviously, do you defeat some of the tax deferred growth? Potentially, but that's still taxed at the end of the day, right? I can tell you this, if you look at our national deficit right now at $46 trillion or whatever it is, personal tax rates aren't going down, guys. They're certainly not going down in the future. I certainly can't imagine a scenario wherein personal income tax rates go down significantly enough that you would regret taking more in that particular beneficiary's case while they're of minority and not working. And then obviously, and Steve alluded to this in the last scenario, beneficiaries who have higher medical deductions, right? Higher professional expense deductions, things like that. You can minimize that tax burden by taking more out of the IRA in those years where there will be taxable income that is offset by personalized itemized deductions. Excuse me, personal itemized deduction.
I have to tell you, in a lot of the cases that I've had here, where we've had somebody with a lot of medical needs and that kind of thing, oftentimes it's attendant care, which are deductible expenses. We've actually, it's something we need to remember. Minimum distributions means minimum distributions. You can always take more. So if I have $100,000 of possible medical deductions at the beneficiary rate here, and I have my minimum distributions, for instance, are $20,000 of ordinary income, it may actually be prudent to increase the amount that you're taking out of the qualified plan so that you can, as you follow it through, offset it with those medical deductions here, and that may be the prudent thing to do. This is something you'd want to do with your CPA, your financial advisor, and your attorney. But there's a lot that you can do with this. And once again, it can, as I said, I have emptied out multi-million-dollar qualified plans, and by offsetting them at the beneficiary level for by medical expenses, not a cent of tax was paid. So you really have to be cognizant of that. Peter, go ahead, Pete.
Yeah, I think also, especially when we're dealing with people with disabilities, the special needs trust, I think in their very nature, and I don't think I'm going to be saying anything controversial here, are meant to be wasting trusts. And what I mean by that is they're meant to be spent during the lifetime of the beneficiary, right? This isn't in a wealth accumulation vehicle for future generations. This is meant to enhance the quality of life of a person with a disability. And so being scared or reticent to take anything extra out of the IRA, if it could create a better outcome for a person with a disability, boy, I got to tell you, I'm all for it.
Yeah. Let's get the last code, and then we can go to the most terrifying part of the program. Have any questions? And in fact, I have some questions for you, Pete, but our last code for the day, code number 3, is 3451. That's 3451. Once again, if you don't have the form in front of you, you can get it by going to gspt.org and look for the tab for attorney resources. Also, before we jump into this, here, just for those of you that are watching us, if you are an attorney or a fiduciary, please consider emailing amy@gspt.org and join our professional listserv. That is one of the few things, yes, we do just keep that for professionals. Otherwise, all of our other materials are available for the public here. And once again, that will help you keep up with some of the things we're working on, developments in California and that kind of thing. So, Pete, before we jump into this, and we had talked about this earlier, and since, well, it is the Golden State Pooled Trust that is bringing you this presentation. Let's say you want to use a pooled trust and get all these benefits. Okay, so let's say you want to join a third party pooled trust and do it through a joinder agreement, right? And for those of you that aren't used to this, when you're using a pooled trust in a traditional way, basically there is a master trust. Think of it as the Constitution, but then there's what's called the joinder agreement. Think of it like signing a contract to set up an account. And if you do it through a joinder agreement, instead of getting your own document, what you get is an account in a master trust. So let's say we were doing this planning and somebody was considering a pooled trust here. Does that work? Are there problems? What do you think, dude?
No problem whatsoever. I think it's a fantastic resource. I think pool trusts in particular are a fantastic resource. I mean, Steve, from helping running the Golden State Pool Trust, the wealth of knowledge, the amount of beneficiaries that you see, the amount of public benefit programs that you may know of that a large bank trustee certainly isn't going to know. Even some of the professional fiduciaries in California may not know. So I really like pool trusts as an option because of a lot of times, the fee structure is extremely competitive, but also the resources that are available there are great. And there's absolutely no issue whatsoever with naming a third-party pooled trust as the inheritor of an inherited IRA for that titling. Now, the question may be, okay, well, but it's not going to be set up, right, until I pass away. Usually it's called a testamentary capacity. You would just put, for example, the Golden State Pooled Trust for the third-party trust for the benefit of Peter Wall. Once you're ready once this, original account holder has passed away, generally that trust is ready to be established, and it will be established by the time it has to be, and it will be established by the time it's ready to receive IRA proceeds. Now, the IRA itself isn't held as part of the pool. Can't be.
That's important.
Right. So it'll be held separately. However, all RMDs, any distribution from there does go to that sub account for the third party pool special needs trust sub account.
So you could do it through a joinder agreement.
Mm-hmm.
Now, this might sound odd. I have a prejudice that if it's an amount of any substance, I personally prefer, which is not in the best interest of GSBT, an individual trust. And if you're looking at GSBT manage it, name them as the trustee. But we're just looking at different options, right? And we're always looking at different options. And we've kind of included, and we're going to be doing more materials, especially for third party, why you might choose one over the other. But for the purposes of this dealing with qualified plans, those rules about it being a valid trust, irrevocable, and being able to figure out who the remainder beneficiary is, and making sure your trustee's not asleep and sends the correct materials off to the plan administrator to do when we don't know what they're going to do with it, but you got to send it to them, right? I mean, that's basically, that still would work.
Yeah. Let's take a stab at some of these online questions, if you don't mind, Steve. I'm going to tackle the easiest one first here from an Mr. or Mrs. Anonymous attendee. Is it best to split an IRA into two IRAs to avoid beneficiary confusion? Obviously, during your lifetime as the account owner, one IRA to be inherited by the adult with a disability and the other IRA to be inherited by the other three children. It doesn't matter. As long as it's done correctly, I don't think you're creating any more efficiencies by having two accounts as opposed to one account, just as long as the beneficiary designations are done correctly, which you can add as many beneficiaries to your IRA as you want. Just be careful that when you're naming the third party, or if you're contemplating a special needs trust, that the trust is named and not the beneficiary with a disability.
And I know, depending on the situation, for a lot of families we counsel here for planning here, oftentimes they're drawing money from their IRA and oftentimes more than is necessary, and they're leaving their investments alone. There may be situations where maybe as a parent, you want to take those minimum distributions, deferring it for your child with a disability, and possibly using other assets for your day-to-day needs. It really depends on the situation, because remember, every dollar that comes out of that qualified plan, you're going to pay taxes on it unless it's a Roth, right?
Correct.
So once again,
Okay. Follow up here from Candace. Sounds so complicated after we die. It does sound complicated. I think the best thing that we can recommend to you, Candace, is have a good attorney, a good planner, a good CPA in your corner to help your daughter without a disability who will be trustee. Always happy to have those conversations. And I'm sure Steve is as well. Also, Steve, when an EDB takes an RMD, look at you go, Candace, already using all the lingo. Out of the SNT yearly, what will that income do to her benefits, such as CalFresh and Medi-Cal?
that's a darn good question. And
Sure.
I'll tell you, it's a question that's changing all the time. Let's say the person was on HUD, just to throw another wrinkle in it. Part of what's going on right now is, for years and years and years, the rules as far as what is income has pretty much been the same. Now the rules are changing. If you're not on SSI and getting Medi-Cal, it's an entirely different set of rules as far as what's for income. For HUD, it's an entirely different set of rules as far as what they're about to count as income for HUD or Section 8 programs and that kind of thing. My suggestion in a case like that, because we're always dealing with how do we deal with investment income, but then how do we deal with benefits income? And a lot of the skill in planning is recognizing that they have the same name, but they're entirely different concepts. Sometimes it's the attorney. I'll tell you, I am engaging care managers more than I ever have before here to look at the different kinds of income, especially when, under the new rules, the income for Medi-Cal purposes is so critical, because we don't want to get into throw somebody into share a cost and that kind of thing. I think a lot of times with this case, and I hear what you're saying, is that it does sound so complicated. Once you get it all working and get a good, what I call a distribution plan together, after the first year or so, it should be relatively simple. But you have to make sure that, once again, and I see in this case that our beneficiary is on HUD, that we're looking at all these different income rules and making sure that the distributions and the rules comply with all of this, and it's possible to be done. Now, this would be one of the reasons why you could, by the way, the thing with the qualified plans, Pete, it doesn't say special needs trust. It doesn't say special needs trust in there anywhere. It says a trust, right?
Yeah, correct.
So, you could have situations where you could create a trust that's a conduit trust, but for instance, for somebody on HUD, that would be the kiss of death, right?
Correct.
That would be wrong.
Right.
In our accumulation trust, once again, we just want to make sure that the people that are managing the trust, and once again, it's the trustees, it's the management team, which is the most important part of the trust. We want to make sure the document is correct. But Pete, it would be pretty hard to screw this up at this point. If you worked hard enough, you could.
You could.
Here, but it's the management team. It's making sure the beneficiary designations are right, and then having somebody who understands all these crazy rules that are evolving as far as what is income.
Right. So that's the key. So Candace, I wouldn't stress out about it. Just live a long time, and this will all be figured out. Do everyone, a favor, your daughters especially, and just outlive all these rules, because unfortunately I have bad news here at the very end, is that these rules are going to change again by the time you pass away. So just as Steve said, having that good team in place is crucial.
All the more reason for programs like this, where we take the professionals we work with and give them the tools here to be able to counsel. I know I get a lot of families that say, I just want to have a simple plan. But I just got to tell you, simple and disability are two words that don't go together. So at a certain level, get over it, right?
Yeah.
And all the more reason why we want to have good professionals. We want to have good fiduciaries. We want to have pooled trusts. We want to have investment advisors. We want to have attorneys who understand this, because when this works to your benefit, it's a magic thing. And when it doesn't, it's not. I'm trying to.
Yeah. Well, we've tried our best to avoid this really complicated question from Susan. So I've had a lot of time to think about it. So let's go ahead and jump in. So Susan's the trustee for a third-party special needs trust that was part of a family trust. Or excuse me, the IRA was part of the family trust that created this third-party special needs trust upon the death of probably the grantor or the first name beneficiary. And none of these beneficiaries of the family trust, probably the surviving spouse, were designated. So we're dealing with NDBs. We're dealing with a 5-year rule. Okay, Citibank is telling her that she must sign to distribute or all money goes back to the state. Well, I've never heard of that. Even if it did escheat back to the state, it's still a countable resource. So maybe they mean estate. Maybe they mean the estate of the original settlor or grantor. But again, I've not heard of that either. So sort of irrelevant in the grand scheme of things here as I get to the answer. Some siblings don't want to deal with it. The IRA is like 20 grand. They have 5 years from the death of the grantor to decide what to do. No, unfortunately, they don't. They have until December 31st of the year following the decedent's death to make a decision as to where these required minimum distributions go for the 5-year rule. So bear that date in mind. Dates are important when it comes to the Secure Act. The time has passed so that now the disabled beneficiary can disinherit, disclaim, right? Is another word to prevent this as countable income, because it's going to go all out to this beneficiary personally. Does this IRA go back to the state after 5 years? You know what? Even if it did go to the state escheatment office, I've never heard of this, but even if it did go back to the state's escheatment office, it's still a resource. The benefit it'd still be in your beneficiary's name. Here, I think we can answer this very simply, although it's a very convoluted situation. Why disclaim it at all? Why disinherit this $20,000 or whatever the case may be for this beneficiary? Why not just open a first party trust for this particular beneficiary, have first party special needs trust, have all of the proceeds distributed directly there, and then you don't have any problems whatsoever. Very easy to create a first party pooled special needs trust, for example, through Golden State Pooled Trust. And take that money directly, and then you have no disqualifying event. I guess the only question, Steve, would be, because I'm not overly familiar with California, is there an over 65 issue potentially?
I don't think there would be. Might even get an Enable account if that worked.
Yeah.
Along that line. I'm kind of a take the money kind of guy, but yeah.
The IRA was mistakenly part of the family trust, including the SNT and all the siblings, but non-designated. Yeah, I mean, you do what you would. Yeah, unfortunately, you could escheat the funds back to the state, and then maybe that's it. Maybe once the funds are escheated back to the state, I'm not familiar.
That might be the way to do that. We've done that before.
Yeah,
it may be. So.
I mean, they also don't have much of a choice. If you're the trustee and you're wrapping up this family trust, they don't get back to you. You certainly have the option to just send them a letter, send them something that where you can confirm correspondences. If you don't decide by X amount of day, guess what, buddy? You're getting a check.
So Anonymous has a good question here.
Yeah. So who are providers of an inherited IRA inside of a special needs trust? So first, just to, sort of qualify this or, sort of illuminate this question a bunch, the IRA is never inside the special needs trust. It's held outside of the special needs trust. And I apologize if that wasn't more clear. I know I started talking about it, but I also know I didn't finish talking about it. So the I in individual or in IRA stands for individual. So a trust cannot own a special needs trust. It cannot be, or a IRA, it cannot be assigned. It's not within it. So it acts as any other inherited IRA, any other IRA, and you're absolutely right. It can be an investment account at Schwab, at Fidelity, at Wells Fargo, whatever the case may be, as long as those required minimum distributions or any distribution from the IRA is going to the special needs trust is what you're looking for.
Yeah, so that's like the Golden State Pool Trust is we are not a plan administrator
Right.
here. The so as far as that's concerned, as far as this sort of planning is concerned, since we have about 3 minutes, I take it we probably have 4 because we got started late, and we want to get that half hour of MCLE in here. Kind of just going back through this. Let's look at this another way. Pete, if you were going to screw this up, what are the pitfalls, right? I mean, let's say it's almost easier. Let's look at how we can screw this up and then we know what to avoid, right? So once again, we want to make sure our beneficiary designations are correct. One of the things with beneficiary designations is, for instance, in our example where we had the 2 equal sisters, let's say that the family involved decides, well, we're going to distribute 70% to the special needs trust and 30% to the non-disabled sister.
Sure.
Well, could they just designate it to a family trust and say, upon my death, trustee, you figure out how to do the allocations here, and I just don't want to deal with this?
I mean, you could, but you gotta be so careful. So just don't, because you're going to run into a situation that's unfortunately Susan finds herself in. And I'm sorry, Susan, you got your hands full there. It's interesting. How to screw something like this up is mess up the beneficiary designations. Okay, I've talked ad nauseum about that. The other part is, and this is, I'm really glad you brought this up, Steve. So, your example is good. Hey, trustee, you figure it out afterwards. I'm going to kind of take that and riff on it for just a second, because here's what, as attorneys, as planners on the call, here's what we see a lot of times. We see, okay, Pete dies. I'm going to start a trust for my 2 children, Mackenzie and Braden. But in the interim, I want to save some probate costs, which is extremely important, and time in California, right? And so what I'm going to do is I'm going to create what's called an administrative trust. And I may not even call it that. I may call it something else in my mind, but it basically says, hey, after I die, but before the trusts are created for my daughter and my son, let's imagine one has a disability, there's this interim period where there's this administrative trust, and the personal representative or the trustee can pour over all of my assets into this administrative trust. And so as a planner, I go, yeah. Don't worry about it, Pete. Now I'm acting as my attorney too. So bear with me here. The attorney comes back to me and says, hey, Pete, on your IRA beneficiary designation, just put your administrative trust or this little interim period before it funds for your daughter and your son, and you'll be fine. You're not fine, because guess what? All of a sudden, you've named a trust that has identifiable beneficiaries as my daughter and my son's trust, for example. But let's say one of my children has a disability. I want that EDB stretch, but everyone's telling me now, the custodian is telling me now, well, you've named 2 trusts. We don't really care who the ultimate remainder persons are. We're not going to look through that. Actually, by Secure Act, we don't have to look through that. So now you're stuck in this 10-year rule because you have 2 designated beneficiaries as opposed to, and I've screwed my my child with a disability out of the lifetime RMD stretch. So that's important because that's a pretty darn common provision in a lot of estate plans.
So I think maybe this is something we'll just say in closing. If you're a family member looking at doing this work here, or even if you're a professional who doesn't do this on a regular basis, you need to make sure that you have counsel that is really familiar with these kind of rules. When they work to your favor, it can really benefit the person with the disability just incredibly here. And when it's messed up, it is just a royal headache and that sort of thing. So it's something that you need to have in your wheelhouse. because this is an essential part of planning. Now, once again, there's lots of education opportunities out there. In fact, I think that Pete and I are supposed to be in Las Vegas talking about
Mhm.
part of this is planning. So, and one other thing to keep in mind, a lot of us look at special needs trusts as their sole job is to preserve somebody's qualifications for public benefits. I will tell you, I am getting more and more cases where the focus is not the benefits, it's the advocacy, and it's also the tax planning. Because even if you don't use public benefits here, by using a special needs trust, a third party special needs trust properly, you can get some pretty incredible tax benefits that now the general public, since Secure 2, does not get. So we are now the exception, and used right, it's well worth doing. So, Pete, you
Amen.
get the last word here. Other than that, I want to thank you and the TrueLink team. Here, mentioned there's a lot of good stuff if you look at the TrueLink website on all sorts of different stuff. So it's since Pete and I have been plugging each other's programs, I just want to get one last plug in. But I just want to say there are a lot of really great resources here, and I want to thank you and the TrueLink team for everything you do for the disability community, and especially for what you do for the Golden State Blue Trust.
Absolutely. My pleasure, Steve. Thanks for having me. And we'll look forward to doing this again.
Okay, I want to thank you very much. Happy advocating here, and we'll catch you later.